do it for you.
Baby, the floor is yours. Yeah, baby, I mean the floor is yours. If it come down to the floor is yours, let me show you how I prove the floor is yours. 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 The floor is yours.
Now it's my turn to tell y'all.
Ladies and gentlemen, good evening and welcome back to another E&M podcast number 7. As you know, myself, Terrence Williams, aka the Superman of real estate, my man Flex the producer, aka the,
Let me do
the
this on
civil activist.
here by the
He
mic.
flexing, he always flexing, boy. But that's my man though. Like I always say, if it were for him, be for him, man, we wouldn't be here today. So on this podcast, so we give much respect to that man. That man do a lot. So, um, but and we got our credit goddess, Miss Ashley. She's off today, so we let her take a break for today because she had some things she had to do, but she'll return next week. But we're gonna jump right into it and introduce our VIP guest for the night. Oh man, this lady here is phenomenal. You know what I'm saying? She has an extensive background, but I'm not gonna get all into that. I'm gonna let her do that. But um, we're gonna welcome the loan officer, the lioness. Man, go ahead, Miss Rhonda. Tell them who you are.
Hi. This is Rhonda Hutchison, and I am the Lone Lioness. You see, I put the D in front of it. That means I'm the one and only, right?
Right on. I know.
But I am a residential mortgage lender. I'm powered by Paramount Residential Mortgage Group. Listen, my motto is I roar with power and passion, and I am very passionate about bridging the gap between renting and home ownership. So I'm excited that I am here today on the podcast today to share my knowledge and also be in front of these gentlemen, these handsome gentlemen in front of me. So I'm excited to be here on today, and hey, I'm ready to roll.
All right, let's get right into it. With all that being said, Miss Rhonda, we I knew you would be just like one of the perfect candidates to come on this show because
Thank you,
we've done several deals together, and I tell you, man, it's just like, one of my things, as you know, is just customer service, customer service, customer service. You know that
and
we
customer
preach on that
service.
all the time. So, it's just being there for people, letting them know, they're important and they're just not a number, right? So we have these talks all the time about that, but I want you to kind of just give them, a little take on, what you do and what kind of products you provide, and just give us some examples.
Okay, sure. And I want to say that there's a lot of lenders out there that does everything that probably the products that I have. Of course, we have the conventional, we have the FHA, we have USDA, VA, we have all of those loans. But just like you said, it is the caring that comes along with and sets you apart, and not because you do it because you want to what they say, fake the funk, but you actually care about
Yeah.
bars. And that's why I love partnering with UT. And I call you T Superman Terrence. I call him T, but I love partnering because I know he actually cares. We have some conversations where we're trying to do everything possible to make sure that the bar get through the closing table. So that's what I love about you. But again, I have all kind of programs that I have your conventional loan, and we'll start and just kind of give you a background of what those loan products are. We have our conventional financing, which conventional financing is for those borrowers, maybe not our first time home buyers, but those buyers that may have a second home or don't need that. I want to say maybe a less risk factor. And that's what our conventional loan is geared toward. And also those that are looking to invest or have a secondary home. And so that's one of the go-to loan for those bars.
Hey,
Now
can
let's
you
talk.
talk about what that those risks you said were less risk factor? Can you kind of expound on that?
Yeah, and when I get into FHA, and I'm gonna tell you some of those risk factors for
Okay.
FHA, and that's why our FHA is considered our affordable housing loan.
Okay.
Those are for those first time home buyers who may not have a whole lot of money saved. They have enough for their upfront fees, and of course, that I know Terrence probably will talk about that. And they have some money saved, but are not a lot of funds saved. And what the FHA allows you to do, it allows you to have a higher debt to income ratio. And what a debt to income ratio is, it's the amount of money that you earn in your income versus how much you spend it. And I know first time home buyers, just think about it, is that the younger or the ones that may have a little bit more debt than I don't want to say usual because we all have debt, but may just have a little bit more debt. And FHA allows for those borrowers to still be able to purchase with a little bit more debt. And also it allows for a little bit a lower mortgage insurance. And with FHA, any loan, conventional or FHA, you have to have mortgage insurance unless you're conventional and you can put down at least 20%. Then you don't have to have it. But normally we know in a first time home buyer that no one has 20% to put down. But it does allow for lower mortgage insurance as well. So that's our go-to for first-time home buyers and those that may have just a little bit more debt. And let's also talk about just a little blemish maybe on your credit report. You may have a past collections, let's say medical collections or something where you're disputing and it may show up on your credit report, or maybe a charge-off that may, 5 years ago or 4 years ago, you may have ran into some financial difficulties and you may have a charge off. And FHA allows you to be able to still purchase with just a little bit of blemish on your credit report. As long as this is the key, as long as you have reestablished your credit. Okay.
So does that mean that those blemishes can still be out there? Like you could still owe a lender? And
yeah, you can still owe. And what it does is it really takes the whole portfolio of your credit and just look at the overall. Okay, how long was those charge-offs? How long was that delinquent credit? Have you reestablished new credit now? What's your credit score now? Are you still being late on your credit, on your paying your creditors now? It looks into all of those factors to decide whether or not they will approve you. And what we call it, run it through our AUS system, which is our automatic underwriting system, to give you an approval or not, what we call it, eligible or not eligible.
The reason I asked that because T. Will talked about this a while ago. Like there are some things that you absolutely need to get removed. So I don't know if you're gonna talk about that later, but T. Will.
There's some things that let me tell you about that now, because especially with FHA, if you have any delinquent federal government debt on your credit report, you cannot get another federal. They won't lend you. They're not gonna give you any more money. Okay, going to default. Yeah, let's just be real about that.
Out of there.
Out of there. And you know they say you will fool me once, but you ain't gonna fool me twice.
Yeah. But that's another federal debt.
Yeah, another federal debt that'll stop you. No, you're not going. If you have a delinquent federal debt, you will not be able to move forward. And what we also pull what is called a CAVRS report. Also, that shows it may not be on your credit report. I've had instances where, let's just say you had a default student loan, but you may have worked with someone and for some reason a credit restoration and that for some reason mysteriously fell off your credit report. Once you run that CAVRS report, it's gonna find any federal debt that you have that's unpaid and delinquent.
Yeah.
So it's gonna be a stop.
That, and you know what, Ron? I'm glad that you said it, because some credit restorations or credit repair, whatever they are, they go in and they have it to where they can get that removed temporarily, right? And I know you've seen that happen a lot. And then yep, and then once they finish what they're doing, it comes back on the report. Now they run this whatever you're talking about. I haven't even heard of that.
CAVRS.
I haven't even heard of that before, but they run that and then they see it right back on there. So now they like, whoa.
Yeah, I see it all the time. I see it all the time where they paid, $199.99 a month and for someone to fix their credit. And one thing they did is remove it temporarily and they paid all this money. But when you run that CAVRS report, you're going to show that indeed that default is still there.
Oh, wow, man.
Yeah.
What is that, CAVRS?
CAVRS. And it probably stands for a whole bunch of stuff.
Man,
It's a
I'm gonna
Cambridge
have to
report.
Google it.
Is that
Yeah,
something new?
Cambridge. CAIVRS.
Is that new or recent?
No, oh no, it's not new.
Hmm.
No, that's and sometimes we think, hoping and praying that we won't find things out. But yeah, that's going to show up. If you have a federal debt that is in default, it is going to show on your CAVRS report.
Oh, okay.
Yeah, yeah.
Gotcha.
And if you do
Wow.
have a student loan debt that is currently in default, and I really just started working with someone now, you actually can call the student loan department, and they'll work with you to set you up on a kind of like plan. Once that you pay for a certain amount of time, they will take you out of default and send you back to the original, like Fed loan or something. But they will. And I'm working with someone that they said if they pay at least 6 months, that they will remove them out of default.
Wow, you just put me on some game on that because I ain't never heard of it. The Credit Alert Verification Reporting System.
Mm-hmm. You
Ah,
came with me, you learn something.
you just put
Yes.
me up on something. So
But that's
I
why
got
it's
to look into that.
even important now, because they're, to your point, there are credit repair people who can tell you like, hey, you're ready to buy. But it's some stuff you're not going to find out until they come to the loan officer. And,
Yeah, exactly.
oh,
And
wow.
that's why it says be very careful when you're working with what I call the fly by night credit repair, because they're a shade tree credit.
That mechanic with that cigarette.
Yeah,
Oh,
under
man.
the tree. Yeah, with a cigarette. But be very careful. Make sure you get a reputable credit repair restoration company
Yeah.
to be that can stand behind their work,
Mhm.
and so make sure you do that. I'm not going to shout out anybody, but I have some people that I work with, and I know they're attorney based, and that means if they need to send attorney letters, we're not talking about getting one of those form letters that everybody uses. No, this is on a letterhead coming from an attorney out of their company that's going to say, okay, we did A, B, C, and D. The next thing is a legal action or some kind of action. They're going to make sure that you do what you need to do.
So that's the weight that comes behind an attorney, is just the legal action.
Yeah,
there's some
yeah,
that
it's,
said
yeah.
it
You think
ain't
about
good.
it. Yeah,
Okay.
yeah. You get an attorney. You get a letter from an attorney and see if you want to
Oh
move.
yeah, that's weight. That's weight
Yeah,
there.
that's it. It
Yeah.
is.
Hey,
But yeah,
nobody like them legal letters.
yeah. Nobody like those legal letter, but it's not just for show. It is that they know that there are rules and regulations that they have to follow as creditors. And when
Right.
they know they're not, and they're not reporting, they're reporting something in error, or they're not upholding the rules and regulations, they know there are fines for that, and they will comply.
Hmm.
Another topic I would like for you to elaborate on, Rhonda, is underwriting, because a lot of people. This is what I explain to people when they're going through this process. I said, be ready in at all times to have every documentation, because ain't no telling what underwriting might come back and ask for. You know what
Oh,
I'm
and that's
saying? So,
yeah, yeah,
I,
yeah, absolutely. And as a loan officer, I try, and what my goal is to make sure that I collect everything I possibly can up front. And sometimes that can be very frustrating to a borrower, especially for, you mean you need all this? Yeah, I need all that, because I rather try and collect everything that I know that I need. Of course, there's some basics that we collect. There's your
right.
W-2s for the last 2 years, your tax return for the last 2 years, 30-day paycheck stub, 60-day bank statements. If you have any kind of retirement or 401k, you always need to send that, because reserves means that you have some money set aside, and they love to see that you have reserves set aside. So that
Yes.
means if life happens, that you have money to go to, as we call liquid assets. Okay.
Mm,
So they love to see that. But I try to get everything that I can think about. But my mindset is think like an underwriter. I'm not an underwriter, but think what an underwriter would ask for if they were looking at a file. And I try to put myself in their place. And even though it may be something that an underwriter, once it goes to underwriting, that you didn't think of, or maybe something that they saw. There's a fraud report that I don't know if you heard of LexisNexis. There's
come on.
something that you may have the same last name that show you have an eviction somewhere. Or let me just tell you, if you have a small business on the side, they're gonna find out.
Yeah.
So
Yeah. So a lot during this pandemic, a lot of people started their own businesses. So have you, in your experience, is that complicating the process, or is it having no effect at all?
Well, if you just started to be able to purchase and to move forward in a loan process, you have to have at least 2 years, either W-2 or 1099. And also, most underwriters want to see that you established, you just didn't start that business. Sometimes it depends on what it is. They like to see that you've been in operation, even on a self-employment, for at least 5 years. They like to see that, but you have to show your last 2 tax returns, business tax returns, either Schedule C, on your tax return. So you need to show that. And if you don't have that, then you can't move forward with a loan.
Well, not for like the primary income, but okay, you just started it and it's trying to, bring it up and say that they're not really bringing in a profit at that time.
Yeah. Oh yeah. And just say let's say your business been established for 2 years. Well, and this is the perfect example where I come across this a lot, where there may be a bar that has W-2 income. They're working, and this is a side hustle on the side. And I don't want to say side hustle because business is business, but they're writing off more expenses. And sometimes it's legit, sometimes they're just trying not to pay taxes. But if you are purchasing a home, do not write off everything that you have for your business, because what it is we use the adjusted income. That means your W-2 subtract any loss on your Schedule C is going to be your adjusted income. So you may make 90,000, but if you writing off 40, then your income is 50. And you're thinking, and I see that a lot. I see that a lot. I had one bar that made like 100 and something thousand, but he wrote off 80,000. I'm serious. And his income, his qualifying income was 20,000. But he makes good money. Credit score was good. He paid his bills, but he's writing off everything. So prepare yourself. If I don't tell you anything, if you know you're going to purchase a home, and it's going to be in 2 years, make sure you hold back on writing off. You may have to pay Uncle Sam, but in the long run, that's what you need to do, because you need to be able to show your income. So
this ain't me trying to get over and find the loopholes, and then I just want to know.
No, but that's what I'm here for.
Yeah.
Yes.
So if I decide I want to buy a house, all of a sudden, and I'm like, you know what? That's all caught up with me now. I did all these, writing off all these debts, or whatever you call them. Expenses. So now I'm like, hey, Miss Rhonda, I'm just gonna cut the business off now because I'm ready to buy a house. Am I gonna be okay?
You're not going to be. One of the suggestions is you can do, but I don't know if it's a good thing or not. You can go back and have those taxes amended, and now you have.
That's the better option than just telling you I'm done with the business.
Now let me tell you one instance where you can do that you can get rid of. If you're showing that you have a LLC, or doing business as, it's even better if you got a DBA, and we see that you had to provide your tax returns for whatever reason, and we see that maybe there's not a substantial loss, but we see that you have a business and you may be beneficial. Underwriter may say that, hey, you need to dissolve that, because we see that you may have a loss. It may not be much, maybe $2,000 or $3,000, and it's really not your really form of survival. As I say, it's just like you say, your side hustle. It may be instances where you do need to resolve that business. But of course, if you're doing real estate, or for instance, if that's your livelihood, and then we know you can't dissolve that. And so and then you have to show proof that you dissolved it. So you can't just say I'm going to dissolve it. You have to show that the business has been closed, or whatever you want to call it. But
But even once you dissolve that, now your clock starts over, right? That 2-year clock.
No, just like me, and going forward, I won't have a loss because I've dissolved the business. Yeah, so they just
won't look at that.
Yeah, they won't take into account that you may have loss of income in the future. Because what it is that you may show a little loss, but they want to make sure not only can you afford it income, but you can afford it in the future. So they want to know, if you have a loss this year, I want to make sure for the following years there is no loss. So I need you to dissolve this business.
Yeah.
Okay.
Right. Because one of the things I'll say, we just don't want you to get it. We want you to keep it. And they
Yeah.
want to make sure. Yeah.
Yeah. Another question, a good question is, so like, when people change careers, that starts over, right? So
Yeah.
just say if you're going from one, not jobs, but careers. So if you're doing the
Yeah.
same thing, that's cool. But if you
Yes.
go to something different, like, if you go from just say from being a nurse and now you're doing that's totally different. So the
That is totally
clock
different.
restarts.
That is true. You have to be in the same industry.
Gotcha.
Really?
Yeah. So you
So
can't
no
be a
matter if
nurse and
I had a huge pay raise in a lucrative field, I can't buy a home.
it has to be the same industry.
Oh wow, that
Now,
is
of course, there are certain circumstances, but then that's a manual underwrite, and that's something you don't even want to get into because that's a person being subjective. So, there are certain circumstances where you just say there's an illness and you can't sit down anymore, and you had to change careers. There are always circumstances.
Okay.
But like I say, that's a manual underwrite, and I wouldn't, yeah, subjective.
I mean, if you have to, then that's
Yeah.
it. But it's
Yeah,
something
yeah,
that
of
you can
course.
avoid if you know that you're getting ready to purchase a home. Hold
Yeah,
on.
don't
to
change
that career
employment.
after.
Yeah,
I
don't
got you.
change careers. And I mean, I have it every day where you've changed, but you're in the same industry. As long as you have a paycheck stub, 30 days, same industry, you have to show 30 days of paycheck stub, you can move forward. And of course, you need to have your offer letter and things of that nature they look for. But you can even just 30 days, just say, for instance, if you wanted to change jobs tomorrow and in 30 days you're closed or you're looking for a home, it's going to take us now a little bit longer than 30 days to look for a home. So you're good as long as you have 30 days worth of income from your new job, 30 days worth of paycheck stubs.
Okay. Hey, there's we hadn't talked a lot about it, but how does if you have a spouse or someone else in how does their debt or their income weigh on the decision?
Okay, good question, Flex, the producer.
Wrong.
Yeah, you flexing today. Well, it depends on the program. Let's start with conventional. For conventional financing, you can have it can be just one bar, even if they're married, as long as you can qualify. You do not their debt does not have to count, and then their income won't count either. But we don't have to count their debt. That's only on conventional. But however, they will sign at the title. They will sign the deed at title, and of course the application showing saying they're aware that their wife purchased this home and they're aware and their name is not on financials. So that's for conventional. Now let me tell you, FHA is another story.
Okay.
Because Texas is a community property state, good old Texas. What's yours is his, and what's his is yours. Any government loan that can be FHA, USD, or VA, the borrower, there can be one co-borrower. But if their wife or the spouse is not on the loan, their debt has to count. Now, not their credit, their debt. So that borrower have to be able to carry the spouse's debt. That's the hard part.
Wow.
Yeah.
That's huge.
That is very, very huge.
And that's all federal backed loans.
Yeah. If all government backed loan, yes.
Oh, wow.
Yes.
Yeah.
And so that's if there's only one spouse. But of course, you can have both on the loan. But whoever has the lower credit score is the qualifying credit score. Just say if there's one bar, I have that all the time, where there's 700s, there's one, but then there's other that have let's say 600, low 600. The middle of the credit score, or the bar with the lower credit score, their middle credit score is the qualifying credit score.
Oh, wow.
Yeah.
So even if they don't want to have them on that loan, so just say, for instance, don't matter. They still gonna use the lower of the middle score of the lower
No,
score.
now if they're not on the loan, if they're FHA and just say they're just using their debt, then of course we're using that bar's credit score. Because they're not on the loan. We're just using their debt. We just have to add their debt. Because if in a community property state, if something goes wrong in their debt, was his is yours, and was yours is his. So their debt has to be added towards the debt to income ratio.
So y'all have to run their credit too, right?
Mm-hmm. You have to run their credit. We have to run their credit, add their debt, but they won't be on the financial, the name on the loan. Again, at closing, they still have to sign.
Yeah.
Mm-hmm.
And there's no way around it because it's
there's no way around it.
It's going to show that they're married when they run the credit.
Mm-hmm. Oh yeah, they're going to trust me. You're going to find out.
Okay,
they gonna find out.
Mm-hmm. And for instance, even if we just say I had this happen before too, that going through the loan process, put on the application that they're unmarried. I had this happen. They're unmarried. Get all the way through the process, getting ready to go to underwriting, and find out that the person is run because the LexisNexis show as a different name. Okay. Yeah. Well, I didn't tell you because we were only married for 6 months. I don't have any debt with his name on it. I don't have any bank accounts. We never had a house. We were married for 6 months. We were young, but they never got a divorce.
Oh, wow.
And so guess what? Yeah. She had to go find him and get a divorce.
So
he has every right to that property.
Yeah. Here's the answer to that problem right here. Ebony said, just stay single. You ain't got to
yeah. Well, I'm not going to say. Yeah, but it does make it easier where you are because we have more options. Do you want to go conventional or FHA? If you can't do one, we don't have to add anybody else's debt. So
yep, that's all on you.
And a lot of times too, to that point too, when a lot of times I've heard stories of people having to try to clean the story up later on, baby, because they weren't totally honest in the beginning. And I've heard stories where lenders like, you know what, I don't even want to deal with you now. So yeah.
And that's what I always say, Flex, is that be honest, because then I can try and help you. Mm-hmm. At the very beginning, we could have said, okay, well, we need to go, before you wrote a contract and did your earnest money and all of this, we could have said, okay, let's go, let's go file for divorce now, which he did, but it was 2 or 3 months later before we had to start the process. But we could have done that up front.
Yeah.
And just be honest, and I want to say be honest. I don't think she was dishonest. She just wasn't. Let me just see. Yeah, forthcoming. That's a good. Yeah, she just wasn't forthcoming.
Is that like a white lie?
Yeah. Exactly. I did tell her. I just didn't tell it. I didn't lie to you. I just didn't tell you all. But
everything.
What about bankruptcies? How does that affect home buying?
But FHA will be most of bankruptcy. You have to be the 2 to 4 years. With FHA, you have to be out of bankruptcy 2 years after this discharge a dismissed date. So that means if it was dismissed today, being the 14th, isn't it? Yep. Then 2 years from today, discharge, then you can purchase. That's with FHA. With conventional, it's 4 years. And it can some be 3, but it's like you say, it's certain circumstances. If you had a medical, you had to have heart surgery, and you had to, you had to file bankruptcy or something. There's always certain circumstances. There's an exception to every rule. But again, you have to go to manual underwriting.
And I don't care how much money you're making now, if it ain't been 2 or 3. Oh, wow. Okay. Mm-hmm. Got a question right here from a good friend, Mary Jackson. She says, what if you can prove that you are a single but married person did all the legwork with no support from the spouse? How does that affect ownership? So that's a good question.
As long as you're married on paper legally, that is it. You have to go and file for divorce, and not just file. The divorce have to be final. You have to have a divorce decree.
So back to this answer right here. Stay single.
Yeah, stay single, and just make sure you're on the same page when it comes to financially. Yeah. Make sure you're on the same page financially. It's going to be, sometimes things happen, and you just, things happen. Because I've heard this, that it always when you get married, one person have all the debt and then the other person don't. So in case something happened, you always can rely on that other person. Not that I follow that, but I've heard that before. Let it just be in your name, let it just be, air all most of the debt. And then if life happens, you lose your job, at least I got my credit, and we can move on.
Yeah.
But
And
now
man.
listen, that is not a suggestion.
right.
I'm just,
Yeah. You know,
don't
just
say
put it
one
on
with a long line in this
Yeah.
thing. Yeah.
Yeah.
but you think about that though, and again, I'm pro marriage, so I believe that in the sanctity of marriage and things of that nature. But it just makes you think about if you can run into those problems in the future, it's no wonder why some people decide to stay single. They don't want to carry on the burden and the debt and misfortunes of others, even if they were dating a genuinely good person. Something bad could have happened, and
Exactly. Exactly.
follows them. And man, it's unfortunate.
It is, unfortunately. And then maybe if that person that's in the marriage that is more responsible, not responsible, because sometimes it's not just responsibility,
Right.
it's just time. I don't have time to pay this. I can't remember. If you have one of those person with that particular spouse that is good at taking care of those things, let that person take care of all the bills, and then you'll know that you're getting those things done that will not negatively affect your credit for those collections bill and medical that shows up. Now, even in lending, we do not count medical bills against you towards qualifying. They are excluded, but they will affect your credit score. And so, and so they can drop your credit score 40 to 60 points just for a medical bill.
Mm-hmm.
Yeah.
And it can be $6. It don't matter what it is. It's a late. It's not based on the amount. It's that it's a collections. Yeah.
Derogatory comments.
Hey, and T. Will, we talked about this, I think, briefly on the first show. When people or family want to gift you money to help towards the purchase of a home, is there any limitations or other considerations that we should think about?
No, just make sure when they give you that money that money is not coming from some source. You have to source any gift. That means when there's a gift letter that has to be signed, letting you know that I am gifting you this fund, to borrow this money, and I'm not. It's not a payback. They're not paying me back. It's actually a gift, and you have to sign that. And then you also have to provide your bank statement, not just your current one, but your previous bank statement showing that money was already in your account, and it's in what we call
the giver have to provide that.
The giver have to provide the bank statement.
So Mary said, "Don't reveal that it was a gift."
Huh?
This is a question right here, Mary Jackson. She says, "Don't reveal that it was a gift." Is that a
Well, if it's in your account, you're going to have to source anything that's more than 1% of the sales price. You have to provide documentation where that money came from. And that's yeah.
No matter when you got it, if it was been in
well,
your
of course it has to be. We asked for the last 2 months of check stuff. So,
okay. So if you got it 6 months ago, then it's there. Then it's no big.
Unless it's a PP. Let me just tell you this. Unless it's a PP. What is that? PPP loan.
PPP loan.
Yeah, I have that where they got that and think they were going to use it for down payment on your house. No.
Wow.
No.
People actually try to do that.
Yes, and you cannot use it. So that money is deducted.
Thanks, Mary, for the question. Here's another. She says they look at it as now you have another loan that affects your debt to owe ratio. Okay.
A PPP loan, we do not count that towards your debt because that's supposed to be forgiven. But there is another SBA loan. It's another one, and I can't think of it now, that we do because it is payable. And it's one of the ones after the PPP loan. And it's a small business loan. If you get one of those, it is have to count it towards your debt to income ratio, the payment.
Wow.
Yeah.
Hey, Rhonda, talk about that. You talked about that that CLTV, that combined loan to value. I didn't quite. That kind of went over my head. Kind of explain that one, how that works.
Oh, okay. The LTV is the loan to value, and what that is, it really tells the lender your risk, and that comes with how much you put down on. We call the down payment. For instance, conventional is either 3 or 5%. If you're a first-time home buyer, it's 3. If you're not, it's 5%. That's conventional. FHA is 3.5. Now that's required down payment. And of course, we know with the USDA and the VA, there's zero down payment. which that's fine. But what an LTV is, the loan to value. What did you actually do is how you determine that is you take the sales price of the home minus the down payment, which can be 3, 5, or 3.5%, and divided by the appraised value. That's how much the home appraised for, and that gives you your LTV. Now you also can put more down on your home, and the lower the LTV is, the less the risk is. So you can have, for instance, I would try, if I have a borrower that, let's say they require the 3.5% for FHA, and for some reason I just cannot get them approved, or conventional. For some reason I'm getting ineligible. That means not approved. If I can go and put that 5% in there and I run it again, it will give me an eligible, because what it is, it reduces your risk. And what they say, you have more skin in the game.
Okay.
Yeah. And so what that is, the loan to value. And I know we talked about a combined loan to value. And combined loan to value means that it's some kind of subordinate financing, like down payment assistance that come into place, where you actually have to count that loan to value. And typically for a down payment assistance, if you're receiving down payment assistance, your combined LTV can't be over 105%.
Yeah.
And that's just for any down payment assistance. So that's how it's used to see what your risks are. And for CLTV, combined LTV, especially on a second loan, when there's more than one loan.
Okay.
So it's just a risk. It's just a risk factor, as we say. It's just saying, okay, if the more the borrower put down, the less risk there are, because we get some money up front.
Yeah.
And that's why an investment property, they require you to put down a lot more. Just for instance, investment, you have to put down at least 20%. Your LTV is 80, and it's because it's a risk factor, because this is your second home or your investment property, and you're not going to pay for it like you're going to pay for your primary, because you're not out in the cold or out in the rain if you don't pay for it. So they do require you to put more down, which is a higher LTV. I mean, a lower LTV.
Yeah. Okay.
But if you got like the VA on a second, just say on a second property, right? You can use that long as your income dictates that, right?
Right. And with the both the USDA and the VA, they're backed by the Federal Administration. So that's a different ballgame.
Yeah.
Right.
That's 100% LTV, because they are 100% back.
Right.
And that was my experience when I still had my first home, when I purchased my second home, and I just had to show that the first home was being rented out, and they allowed me to go to my second home with no issues.
Yeah, second home. Yes, that is.
Yeah.
And usually on a secondary home, it depends on your credit score. Usually it's just 10% down if you're having a secondary home. But when you talk about investment property, there's 20% down.
Hey, this is a question for you both. I know a lot of people in their mind, they're like, I'm a handyman. I'll go find a house, even if I got to put some work into it and fix it up myself. So can y'all talk about the lender required repairs piece? Like, what do lenders what will they lend on, and what will they not lend on?
Okay, appraisals, inspection. Let's say, for instance, you found a property that you wanted to renovate yourself, but you wanted a lender to loan you that money for you to do that. It's not going to happen. And I tell you why, because when you do a renovation loan, you have to have licensed contractors to come out and give and I want to say quote, they have to, it's a lot. They have to show that they're licensed, they're insured, and they have to give an estimate of how much that home is going to take to become livable or be able to, So that's now, if you buy something, as long as it's appraised, what it's worth you buying. If you buy it for 105 and it appraised for that much, and the appraiser doesn't give a subject to, that means that the plumbing is not messed up, or and then you can fix on that yourself. But to get a renovation loan, you would have to have. You can't do it yourself, and you can't have your uncle Ray either do it. You have to have.
Even if Ray is a company.
Well, if Ray Ray is a company, he's licensed and insured, and he can tell it. Yeah, and Ray Ray can do it. But Ray Ray just coming on the weekends to help you. That's not. We're not going to loan you that money.
But if I'm needing, say, if this home needs a new roof, and most lenders won't lend on that property, right? If it's
I'm not going to say we won't. Most of the time, that's going to be a subject to. Let me just tell you that, and that means it's the appraiser is going to come out and they say this home is valued at $300,000, but it's subject to the roof repair.
Mm-hmm.
Before that appraisal is finalized, the appraisal has to come back out. The roof has to be done, has to come out, and it's no longer a subject to appraisal.
Mm.
And so they have to come back out, and a report has to be written, and sometimes you have to show and I think they do have to show pictures that it's been repaired.
Yeah, they do.
Really?
But you can do a now, Rhonda, can't you do a 203K?
Yeah, that's a renovation. That's an FHA renovation.
Yeah.
Mm-hmm.
So if they needed that, they can, because they'll roll all those into the repairs.
Right.
Into the roll of repairs into the loan. And then you'll just have that into
and
the
that's
loan.
your final.
But that's for primary residence only, or that's not for
primary residence
homes, right?
Mm-hmm. Primary residence.
Okay.
And in 203Ks, there are two different kind of. There's called the limited, where it's less than $30,000, and then they call the standard, which is over $30,000. And of course, the $30,000 over $30,000, well, limited, you can't do like pool. It's just those minor things that you want to do. But when you go to standard, that's when you may have a jacuzzi that you may want to do, or there's a pool that needs to be repaired because it's cracked, and that can be lumped into the loan as well. But when you're limited, then it's less. It's $30,000 or less.
What determines? I guess what are the limitations for it being a limited versus standard? Is it just that
the
price?
dollar amount.
Okay.
Price.
All right.
Okay.
Just the price. Anything over $30,000 is standard.
Okay. Gotcha.
Hey, can both y'all, any one of y'all, talk about what is the purpose of a USDA and how can someone qualify for a USDA loan?
Well, I'll start and then T, you piggyback. The USDA loan is really for those to get you into those rural areas that they're trying to develop.
Yep.
And it's like those, can we say the country?
With a K.
With a K.
Country with a K.
KUNTRY.
The country,
Yeah.
Yeah, those areas they're wanting to develop, and they're concentrating on doing their funds in those areas to develop them, and that's why they're giving the zero down payment. Now, let me make sure that everyone understands that does not mean you're not bringing anything to the closing table. That means that there is zero down, but you still would have to bring closing costs. Yes, escrows, anything to that, but you don't have to have a down payment because your funds to close include your down payment and your closing costs and your escrows and your prepaids. And we can get into that's too much to get into, but all of that is what we call your funds to close. And so that's why they have those.
I don't know how this happened, Rhonda, but one time I had a young girl that had a USDA loan, and she was working with the USDA out of here in Canton, and she just had to bring them. She had to put $500 down, and they paid for everything, the closing costs. I mean everything. And I was like, what type of program is that? Like I didn't understand how they did it, but she was working straight with the USDA department there in that area.
In that area, and it may have been. I know that they have a particular program that lenders can offer, but then they have like an internal program, and it's income driven, and it's for the low to moderate income. And those programs are internal. Lenders cannot offer those programs. So it may be one of those programs, or it could have been a lender which allowed her to what we call overlay her program, where they may have used another assistance on top of it.
Like a nonprofit or another kind of assistance or whatnot.
So those are probably the reasons why.
Yeah.
that she
Okay.
came with zero down.
Okay.
And it wasn't, and well, you would know that. I was going to say it wasn't because you had some seller's credit, but you would have known that.
No, it wasn't that.
Oh, you're the Superman of real estate.
No, it wasn't that.
Mm.
You know what I'm saying? You know how they work on some things. You can only do
Yeah,
it
Yeah.
so much. You
yeah.
can take on those on those
Yeah.
seller
And that's
Well, I'm
probably
credits.
glad.
what it was.
Yeah.
She
Well,
probably
I'm
was
glad that you
ready.
brought up the that there's a lot of misunderstanding that zero down, meaning like,
Yes,
hey, I get to come to closing with nothing. And I know people have been blindsided and like, hey, they tell me I gotta have $2,000-3,000 or whatnot. So can you, I mean, you don't have to go in great detail, but what can those other fees include, that make where they have to bring closing costs?
Yes, we have our closing costs, and that's the processing fee, underwriting fee. Those are just the minimum. We don't have origination fee. Some lenders do have, and some brokers do have origination fee, which is usually 1% of the loan amount.
Mm-hmm.
And then also you have your prepays. Your prepays is insurance. It's just that your insurance have to be paid a year in advance. So anything, and that's included in your closing costs. So what your funds to close.
Yeah.
Also, there's escrows. Your escrows are funds that are sitting in an escrow account for if life happens. You can be able to, your insurance and your taxes will be paid. And typically that's 3 months of insurance and 6 months of taxes. Sometimes it's more, just like now it's going to be more because we're over 6 months of taxes
Right.
being due. And of course, they'll be due in a December. And so those are escrows that are held in an escrow account. Of course, there are title fees for the title, for title search,
Mm-hmm.
and what we call title and lender search. So those are all the fees that encompasses your funds to close. So your down payment is part of that. And the only thing is when you have down payment, a zero down payment, then that's the only thing that's eliminated. Everything else has to be done at the closing table.
Right. But
That's
the right
it.
agent that's aggressive and savvy, he can get a lot of those waived or paid by the seller, or I don't know what.
Maybe about a year ago.
yeah,
Not
yeah. I'm
really.
about to say, look, you
It
can be
pays over.
aggressive, you can be a
No,
savage.
now, like the old folks say, now don't part your lips asking for.
Hey, oh,
No,
you
yeah,
can, but you know what
yeah.
they do? You know what they do with that
You
contract?
don't put your contract in the trash.
513.
Wow. And that's because of the type of market we in right
Yeah,
now.
that's because of the
Seller's
type of
market
market
and
is.
not.
Yes, they have options now. They
Yeah.
have
Yeah.
options now, and you're right. I remember when you could get $5,000-6,000 in closing costs or more.
Yeah.
It just depends on the sales price of the home. But now that's not an option right
Yeah.
now in this market.
Yeah.
As a
I
matter of
tell.
fact, you're telling them what you're going to pay them. Because I
Yeah.
had someone say, "I'll pay some of your sellers, your seller credit, your seller's costs." And so, so now it's reverse.
Wow.
Man,
I'm sorry. Go
I
ahead, T.
I know on a couple of my listings I just had, they paid title policy.
Yeah.
So
Yeah.
I mean, yeah,
Yeah,
so
I
they
mean,
not just went over, but paid over and title. So I mean,
mhm.
it's just crazy stuff happening out here right
Yeah,
now.
it's a different market. It's a
Very.
different market. And the thing about it is that we don't know when it's going to turn around.
Yes.
But, and T, you can attest to this, but we still have, I'm closing loans all the time. They're still happening. I think it's just more strategic now. You just have to know what you're dealing with. You have to be prepared, and you have to have some funds.
Yep.
Mhm.
Just be prepared for the funds part.
Yeah,
I'll,
yeah, just be prepared.
and Rhonda, what's a good rule of thumb for funds? Like what 3%, 5%? What's the rule of thumb to have? Just have sitting in your account
As
of your
much as you
purchase
can.
price. What's the I know that, but so
Yeah,
like on a
at
percentage,
least 2 to 3, at least 3%, because your upfront fees, they'll come back to you in a credit.
right?
Like as your earnest money and your appraisal, they'll come back to you. But minimum, and the reason I say as much as you can, that's just kind of like a guideline, because at the end of the day, and you see it all the time, is that there's something gonna come up on your CD at closing that you did not expect. For instance, taxes is one of the worst ones, especially if you have a new construction. Okay, let's talk about that. When
Yeah.
Oh,
you have a new construction,
that's
Yeah.
major.
I got hit with
yeah,
that one time, Lord.
yes, yes, because the builder is is you have to use an unapproved tax amount. They're paying for all these lots, 50 lots, and you're coming to the closing table. You're paying for what the tax is going to be once the property, the home is completed.
Yeah.
For instance, there was one that I had $84 was in taxes that the builders were paying because think about it, they have 50 lots. So that was last year's taxes. But now this year's taxes is $700 and something because the home is completed. So so just be prepared because that can put you in a position that you don't have the funds to close. That's why it's always good to be able to pull from a 401k or have a savings where you may have an extra $5,000 in case something happens. Because when we get the numbers, the tax docs from title, we have no control over that because that's what it is, And so just be prepared. And that's why I want to say 2 to 3, but I want to say save as much as you can for those unexpected things that may come about. So you won't be at the day of closing and you receive your final CD and say, how in the world am I going to come up with this extra money?
Yeah. So Mary, she says people from out of state like California will pay 2 times the asking price. So that's back to the other conversation we just had about it being a seller market right now.
Mm-hmm.
All day, every day they doing it.
Yeah, they're doing it. They're doing it left and right. And
so what are you telling your customers then, and that are competing out here with these cash buyers who got the money? So I mean, is there one loan that you would recommend over another, or I mean?
Yeah, conventional. I'm gonna tell you, conventional is going to be the first that they're going to take consideration in is the conventional financing, and that's mainly there's 2 reasons. But I'm telling you, the main one is risk, and that's because an FHA loan is just a little bit more risky because of what we talked about earlier. May have a little bit more blemishing, but that's not the main reason. It's a mandatory clause where in an FHA loan, you have a clause that says, if this home does not appraise for the asking price, sales price, that the buyer can walk away and get their earnest money back. And sellers do not want to deal with that.
Yeah.
Nope.
Not want to deal with that. Okay. So that's one of the main reasons why they shy away from FHA loans. And then because also FHA appraisals are tougher.
When you're talking about fair housing, rules and all that, that seems like that would put low income buyer at a disadvantage. I mean, maybe it's trying to catch up with it, but
it is. I mean, it honestly is. But there's nothing.
What can you do?
Yeah, we don't control. We don't control the market. The buyers do. And that's what I tell people. I say, you know what, man, nobody can tell you about this market and what and all it's doing. I said, the people that's coming in buying these homes is what control where these prices go.
Yeah.
Long as you have buyers,
demand.
That's it.
And it's not discriminatory because they don't know who these buyers are. It's not that I don't know if what race you are, or age you are, or gender. So we can't say it's being, I'm being discriminatory against you.
What if my name is an ethnic name? No.
That's why I'm giving all my contracts.
Yeah. So here's a good one from Kanisha Thompson. Thanks for the question. She says, what happens if you don't have these new unexpected amounts at closing, which is a real concern for some people,
Then
you're in trouble.
You have to go for a gift fund. You have to find somebody real quick that can give you some money.
Dice game.
Yeah.
Casino.
Yeah. And sometimes the lender, if they're able to, not all times lenders are able to give a credit, especially in a down payment assistance program, because that's already, really scarce thin on a down payment assistance. But sometimes the lender can offer. I have instances where the realtor gave some money. T may not want to hear this, but
it happens because sometimes you gotta do what you do to get it closed. And I mean, if that's the case, sometimes you gotta go in and throw it in. So
you have to
call a commission or something. Is that what you're?
Yeah, It's a lender's credit
that
you would give to
But go back to Kanisha's question though. That you should have those that CD. Yeah, that's that closing disclosure, you have what, 72 hours to get that out before closing. So
Actually, well, that's on the initial CD. That's on the initial CD. There's an initial CD where it have to be 3 days for closing. You
right,
can't close. And then, of course, the final CD is
yes,
usually, believe it or not, the
that's
day
it.
of closing.
That's the
Yeah,
boy.
yeah. When title and closing have balanced their numbers,
Yep.
then you get your final CD. And that's when you have to rush and say, go, you need to wire this amount of money, or you need to go get you a cashier's check for this. But they, right, 3 days before closing, you have to have your initial CD out.
Yeah.
Yeah.
And I think sound like y'all kind of stating what Mary is saying here. I recommend to avoid surprises at closing. The buyer can request a buyer payout sheet, or the seller can ask for a net proceed sheet.
Yeah, you can, but there's always things,
That
even, and you're
change.
right, Mary, but there's always things at the last minute that comes up. I see it too often. I'm talking
Yep.
about where the buyer is at title, the buyer is selling that title, and they're
Mhm.
still trying to balance the CD because there are discrepancies. And
Really?
so, but you're right, Mary, that's true too. But we always want to be prepared for the unexpected. But you're
Yeah.
right, Mary.
We just had that happen on our last closing. It didn't get balanced to the, I mean, by 2 hours before closing. So
Well,
everybody was scrambling.
well,
Yeah.
I had it where they were sitting at closing
Mm.
and was waiting to close
Oh
because
wow.
there was something that came up. I had one where the last name was, well, that don't have anything to do with money, but was on the birth certificate was different from what the documents had. So
Yep.
it's just all kind of things
Yeah. Yeah.
that can come up at the last minute. Or the most recent was taxes,
Yeah.
Yep.
where and it was a new construction. So that's why I
Yeah.
always be prepared because we don't know
Always
what
be
those
prepared.
tax documents are going to
Yeah.
be until we get
Yeah.
them.
I got another question for you. I know we're getting ready to close here, but this is really for both y'all. So most of our listeners, our followers, they aren't wealthy. When I say wealth, they aren't millionaires and billionaires. So they're coming here, gotta, you know, maybe the income in this seller's market. If you have to advise somebody, like what's the best, avenue they can take to purchase a home right now?
Tim,
I,
let you go first.
I tell people, I said, I know it's a crazy time, but we don't know where these prices are headed, right? And nobody can. We can only go by what the market is doing.
Yeah.
Just doing your due diligence, basically. Um, I tell people, if you can do it, if you can't, then
Just
ain't nothing
wait.
you can do about it. You know what I'm saying? You gotta wait
Mhm.
anyway. But you do have those funds. But my thing is this: regardless of what it's doing now, it's still a good time to get in because
Mhm.
you
It's
have you have to own something because that 6 months ago that you said, "Oh, I'm gonna wait," look what it did.
Mhm.
so you got to try to get in there somehow.
You got to
Yes.
try to get it. Just get in
Yeah.
there, because we don't know what it's gonna look like by the end of this
Yeah.
year. We
So
don't
I
know
was
what it's
going to
gonna,
say, I
you know.
think something to consider, especially with people are jobs are teleworking now. A lot of them are working remote, so the ability to move farther out from the
Oh
the
yeah,
major
most
cities,
definitely.
there's tend to be depending on the area. Of course, every place is different. The competition is not as great sometimes the further out you move. I know T was telling me maybe a month or so ago, one of his clients, he took them all the way to Tyler to purchase a home. So
Mhm.
some places are 100% remote, and
Yep.
if that allows you to move further out, maybe that's an avenue to consider. You know,
And then one other thing that I want you to consider also is just think about it. You're throwing money away when you're paying the landlord.
It's always a
So
throwaway.
it's a throwaway. If I have to pay extra funding, and if I have it, okay, it's different when you don't have it.
if you
But
don't
if
have,
if I have a 401k, pull from your 401k,
that's what I want to say.
invest in the home because at least you get equity. I mean, you're building generational wealth,
Yeah,
and all of that is more important than giving the landlord your money to fund his vacation, his family vacation, sending his kids to private school, and his yacht, putting gas in his yacht. Okay, so
Well, Rhonda, don't go too hard on them now because I got rental properties. But I'm just saying, But I'm just
Yeah,
saying though,
would you
look,
want to know?
look, yeah, I'm just
We
saying,
ain't talking about you. We ain't
hey,
talking about you.
hey,
I'm just saying.
That
but I'm
is
just
different.
saying,
Okay.
that, if people, you know, that's just some people like the rent, but they're really not understand the benefits from it. And I ain't gonna even. It's
It's generational
generational
wealth.
wealth,
Yeah, it's generational
indeed.
wealth.
But people don't look at it like that. But the thing you should be looking at is where your money is going, where you putting your
Mm-hmm,
money at. You know what I'm
mm-hmm,
saying? Versus rent versus owning something you will never
mm-hmm,
own. Just say, for
Yeah.
instance, if you stay in this house, like I got a formula that I like to let my clients know that, like, look, you might not be an investor, you might not, but here's a way you can get in the game. You can stay in
mm-hmm,
that house 3 years, let it build that equity. And right now it's building like crazy, right? The next 3 years, you can rent that house out or sell it, take the equity out of it, go buy your next property. Now you got
mm-hmm,
proceeds because in order to get everything without paying those capital gains taxes, you have to be in that home 2 years for you to
Yeah.
get
mm-hmm.
all the proceeds from that home. So
Right.
that's just another good thing to know that you
Yeah.
do have to be in that home at
That's
least
good.
2 years before you sell and you can get all the net proceeds out of it without being taxed.
Mm-hmm.
Without being taxed.
Without
That's
being
good.
taxed.
That
Yep.
is
Right.
huge. That's huge. Especially in these markets now. Some of my neighbors, they moved in a year ago and they already dumping these houses because
Yeah.
the cost is up.
Mm-hmm.
I guess they made the decision like, hey, the gain is so much that I'm willing to pay.
Yep.
The,
I'm willing to
Yeah,
move.
exactly. I'm willing to move. And the
yeah.
interest rates are still low, you guys.
Yeah.
Yeah.
Interest rates are still low. And we don't know how long that's gonna last. It
That's
may
true.
last another year, may change tomorrow. We don't know. And so
Yep.
the interest rates are still low, and it is still a great time to buy.
Bye.
So do
Mhm.
you offer loans for investment homes as well, Miss Rhonda?
Mhm.
Okay.
Mhm.
Okay.
Mhm. Yes, at
Yeah,
least
they know everything you offer. Cool,
yeah.
cool.
Man,
As long
Rhonda
as you
do it.
don't have more than 10 properties.
Yeah.
Huh?
She do it all.
As long as you don't have more than 10 properties,
Oh,
up to
okay.
10 properties.
So T Will can't come to you, but some
No, T, no,
Oh,
T.
come on
You
now.
got you got to go to commercial.
Hey, but you know what? That's weird because I've and see I'm glad you brought that up because every lender has their
It's
own thing
different.
that they do, right? Because I've
Mhm.
seen it where some can do, you know, five or more.
Yeah, up to 10. I can go up to 10.
Yeah,
You can't have more than 10 properties.
but
You.
but to you, is that up to 10? What's considered commercial for you?
Well, we don't do commercial.
Okay, so see, you don't see. I knew and remember Flex. We had the girl from the credit union here.
Yeah,
Mhm.
credit
She was
union.
said I
Okay.
think five
Mhm.
was the limit to where it turned into a commercial side.
Mhm.
Remember
And let's
that?
see, you're talking about a credit union
Since you were
too.
saying
A
four,
credit
yeah,
union which is
anything above
opposite.
four
Yeah.
was
Right, right. Anything above four is considered commercial. See, that's why I
Mhm.
said everybody has their own kind of thing that they do when it comes to lending. So you just have to kind
Mhm.
of,
yeah.
get what
And
you
when I
want.
say 10 properties, I mean we can do anything 1 to 4 is considered, you know, residential, but once you get over, even if it's
So that
considered,
1 to 4, if you got that, that's not considered four.
yeah,
It's
that's considered 4.
oh, it is four. Okay, so if I got a fourplex, that's
Mm-hmm. Yeah,
four out of
four.
my
Yeah.
10 that I can use
Mhm.
to come to you.
Yep.
Okay,
You down to 6.
That-
yeah. Hey, it's a good problem to have, though. Hey,
yeah,
Yeah,
that is.
that's a good problem.
yeah,
Yeah,
That
I'm not
is.
negative. That'd be a good problem to have.
That's a good problem to
cool,
have,
cool.
man. One point
Wow,
seven
this has
five.
been
That's
great.
Do we have any more questions before we here we go. Mary, she says, I was talking about the interest rates, and these are I don't remember a time that they've been this low. So I would say
crazy.
a plus of
Mhm.
trying to buy, but the flip side is the inventory is low. So
Mhm.
What is
the
that off of though?
huh?
1.75. What is that? That
That may be an adjustable rate or some of those
what
entry
rate is
level.
that? Mary,
Yeah,
what rate is that?
that's how much that's what I'm. Yeah, that and a lot of people get that confused when they think 1.7 as of today. But that's how much money you can borrow for. Just say, for instance, revolving credit or something. That it doesn't have to do with
Uh,
lending. That's what. Yeah.
maybe.
And so,
She said that was on
MSNBC.
MSNBC today. So
yeah,
what is the going interest rate right now for residential?
it's
Is
still in
it-
the threes, still in mid threes.
oh, I
And
thought they had dropped under 3, so it's mid
well,
3.
a couple, about 3 months ago, they were down. They were in the twos. Yep, and once Biden won, And I'm not going to put it on here, but no, and no, and it's just not Biden. It's just that the economy started to make a turn.
Yeah.
The vaccine and the hopefulness in the economy is just started to turn around, and that's what happens when the economy is bad. The interest rates are low, and when the economy starts getting good, the interest rates are high.
She said she just got her residential for 2.25%. So
is that on a new bill or a refi?
can you let us know, Mary? Is that on a new bill or a refi or pre-existing home? We ain't trying to get all in your business, but a little bit.
I just want to see what that's on because that is. And how long ago that was, Mary? Was that?
Yeah.
Oh, that was refi. Yeah.
Refi,
That's
okay.
Yep.
And so how long ago was that?
Yeah, Mary. How long ago was it? How much was the house and how many bedrooms, square footage? And
well, it's really just how long ago.
Yeah.
When I refinanced, I was in the twos too. But like you say, that's been 6
February
months ago.
22.
Yeah, that was February.
Yep.
Okay. Now, no, they're not that low. Yeah, because I refinanced in February as well, and mine was a two. Mine was the low twos. So yeah, but now the interest rates are. You more than likely you're not, even if you have a credit score of 750 to 800, they're probably not going to be in the twos, not low twos. It may be in the high twos.
High twos. You
probably 2.8. Right.
Yeah.
So generally speaking, when would y'all say so you should refinance? Like if you're saying I got a home now that's at 3.5% and the interest rate now is for refi is 2.75. Is it worth it? Or does it need to be more than a point lower or?
Well, this is the thing about it. It has to make sense to you why you refinance.
That's what
if you're doing just for a rate reduction, you have to see, okay, because what you're doing is you're taking any kind of closing costs and you're adding it onto your loan. So it's a beneficial for me to do that if you're doing a rate reduction. Now, if you need cash out and you need to pay for whatever you want to do, a renovation, you want to do the kids to college, that makes sense to you because I'm using my equity to be able to do that. But a rate reduction, it just depends on if you can't save at least 1%, go from a 4% to a 3%, at least maybe close to it on a rate reduction, it really kind of don't make sense. But it's individual. You have to do the numbers to see if it makes sense.
Yeah, what's she talking about? When you talking about long term, but some people just like right now, I just need some relief, month to month, so if they already been paying on the house 12 years and they refinance for another 30 years, I mean, I ain't the numbers guy.
That clock start over though. That's what people don't really look.
Yeah.
If I done paid 12 years on a home, if I refi, I want to refi damn near in that same amount with about 15 years. That's what I'm looking for because I done already invested 12 into this. That's like saying 12 plus 30. You know what I'm saying? If you really think about it, you got to start over though.
But would it make sense to do it for 30, but pay it more month to month if I'm able to?
Yeah, you can't do that. You can do principal only. Yeah. You can. I mean, you can do that. And then they'll do the calculation. You can pay an extra $100 and how much you would save over. You can take 7 years off of a loan by just paying $100.
That's a good. And you're right. So people think that it takes a whole lot to pay that down faster. So you're saying another $100 can make the world of a difference.
It can make a world of difference. Yeah. Yes, it can make a world of difference.
Yeah.
Because if you make like Rhonda, correct me if I'm wrong on this. Like if you make just like a one whole payment for the year, ain't this equivalent to like taking about somewhere between 4 and 5 years off of your payment?
Every year, yes, it does. And when I can go my servicer and they'll actually give you a calculator of how much it'll take off if you pay this or you pay a mortgage payment every year, extra mortgage payment, or $100 every month to go to principal only. Then they will give you. So do that. Look at your servicer website because I haven't seen any of them that won't do it. And be able to say, okay, I can do an extra $100, or I can just take when I get that income tax to pay one monthly payment. Yeah. It does help. Yeah.
Yeah.
Exactly.
You're married. Hey, Rhonda, I said I'm going to buy me some Jordans.
Yeah, I'm
No,
buying me a new TV. You know that's what you
yeah.
do.
Daily lunch costs added to your monthly mortgage can make a difference. Yeah,
Oh
that's
man.
the thing. Like, not
Exactly.
only are we talking about the types of products, but we want people to be more savvy with their money. Making sure that they're wise with it. Again, I mean, T, we'll talk about this the other day. As much we work hard, so we do want to enjoy life. So we don't want to
Mhm.
tell folks don't enjoy your life, but
Right.
you talking about the life of a loan for a mortgage, you're potentially saving hundreds of that tens of not hundreds of thousands of dollars from
Absolutely.
from paying it off.
Absolutely.
That's good.
And
That's good.
you look at it like this because the first 10 years is pretty much all most of that is going to interest.
Yeah.
You can add some more into that.
I just give it to him on
Yeah,
that.
the
Yeah.
first 20
It's
years
not first,
almost.
but I'm just saying before that principal start to adjust and
Yeah, you
increase
start to see
and
it.
put
Yeah.
more over to the principal, them first 10 to
Yeah.
12 to 15 years, you straight interest, baby. So when
Hmm.
you that's why I tell people, I said, so when if you're going into a refi, it definitely has to make sense number wise.
Yeah, it has to make sense. And
Yeah.
even maybe do a 15-year,
That's
versus a
Yeah.
30-year.
Not
You may
only
have
that,
the same mortgage payment, but
yep,
you're taking off
15 years
15
in the
years.
game. Boom.
Yeah.
what about this
Mhm.
mindset? I know this is a starter home and I'm not going to be here long. Does it make sense to give that extra payment if I know 3 to 5 years I'm probably going to be gone anyway? Yeah.
That's my opinion. Not if you know that you're going to, or you or and I'm trying to think of because I don't do much of them. It's that when you have like a 7-1 where you know you're only going to be there in 7 years, and every year that seven after that 7 year, your rate will go up
Yeah.
1%. Yeah, and I don't do much of them. I'm trying to think what you call it,
You
but
talking about an arm?
yeah, arm. Thank you, Mr. Mortgage number
I
two.
don't. That's
Superman.
like to me. This is how I put an arm. I got two of them. Why would I give you one?
Yeah.
You
Okay.
see what I'm saying?
Yeah.
That's the simplicity right there. I would ever do an arm. Like I don't
Mhm.
care if it was 0.025. I don't because it can adjust. That's what it does.
Yeah.
But there's
And that's
limits on how much they can increase, though, right?
yeah, just like a 7-1, for 7 years it's stable, and then after that it'll go up.
So if I got an
little.
aggressive repayment plan for, not repayment, but to hit it hard for 7 years, I can see how. But I mean, you got to be disciplined and
You
really
have to be
understand
disciplined. And life
where you want to
happens.
be. Yeah.
Yeah. And a lot of military people or people that know that they travel from or they're in on like a VP that know that they're usually at a company and then they have to move to another
makes
state
sense.
or something. They may do those because they know that they're not going to be there long term.
Yeah.
And
And
see,
they're usually moving before that 7 years up.
but that was part of the thing with the crash before. A lot of people got into them arms, and
Mhm.
that's
Oh
what
yeah.
happened to their loans.
Or the
Yeah.
80
Know what
20.
I'm saying?
Yeah.
So people have
Mm-hmm.
to really like, but I can't tell you about your situation. I can only tell you about
Oh
me.
yeah.
You know what I'm
Yeah,
saying? Like
exactly. Yeah.
that's why it doesn't work for me in my situation because
Yeah.
I can't see it. And
Yeah.
just like you said, you would never do if it was you staying in the home and you knew you was gonna move in you wouldn't pay the extra payments. I would because I'm looking at okay, so I'm paying this down a principal, but I'm getting closer to relinquishing all this interest that I'm paying. So to me, it makes sense because I'm paying this for my equity, right?
Mm-hmm.
When I sell, I'm gonna get all this back and probably some more. So that's how I look at it.
I can see
Well,
that.
you can look at it. You can look at it that way, or you can put that money and save it. Either or. But
Or buy
it's
me
the individual. It's like I say,
some-
you have to look at your certain
Situation.
situation. It's not
Yeah.
a cut and dry because
That's right.
Right.
everybody have a
That's
different situation and life is different.
But
And
that's why
everybody.
it's important, I think, for you as professionals to sit down with your client and
Oh
give
yeah,
them as
most
many
definitely.
options as
Most
possible.
definitely.
Because if I want to buy
Right.
some rims and Jordans, I ain't doing it. I'm just saying, man. I'm kidding y'all. Hey,
No, you ain't kidding.
I'm gonna see him tomorrow going down the street. Boom, boom, boom.
hey,
Yeah.
hey, T. Will, next time we go out and we eating, and I got
Yeah.
my legs crossed, I'm like, man, check these shoes out. Check out these
I'm gonna
J's,
check
bro.
you out, dog, but I know
Yeah.
you probably got plenty of them anyway. So
I don't. I do not. Yeah, Mary said you
Hey,
can round off your monthly payments and have the extra to go towards the principal. So yeah, you're right about that.
Yeah,
Hey,
yeah.
shout
Pretty
out
much.
to Lady
Yeah.
Bug for watching the show. Appreciate you.
Yes, it's been a blast. It's
man, it
been a blast.
has. It
Yeah,
has. Miss Rhonda, we really appreciate you for coming on, man, and just giving that game and that wealth of knowledge because
yeah,
a lot, especially in our communities, how we grew up and stuff like that, we didn't understand this space. And now that we've gotten into it, we've seen a lot of things, we've learned a lot of things, and we like to share this with. There's no benefit in keeping this stuff hidden. You know what I
Right,
mean? 'Cause
right, absolutely.
yeah,
yeah,
it's just everybody should know this. So that's why I'm we all are very passionate about it, and that's why we come on every week to
yeah,
give people game on this type of stuff because
Mhm.
yeah.
whether you already got it or whether you thinking about doing it or whatever your situation is,
Yeah.
it's just us providing information
No
that you
question.
can, news you can use. So
Right.
And in this instance, actual resources. So we got this 1-2 punch of the real estate agent, Superman T. Will, and great loan officer, Rhonda Hutchison. So Rhonda, we're gonna let you plug yourself
the
and tell the
lioness.
people how to reach out to you and how willing you are to work with them. So this is your
Absolutely.
time.
Absolutely. I'll be happy. I mean, give me a call if you have any questions about purchasing, refinancing, whatever that option that you're looking to do. Give me a call. You can give me a call. I'm even here if you're not even ready right now. If you just have questions for me, you want to know how to get prepared, what do I need to do? Give me a call at 214-856-3747. Again, that's 214-856-3747, or you can send me an email, or you can text me, same number, or you can send me an email at rhutchison, Hutchison, at prmg.net.
Yes.
And look, I'm here. I'm just like T said, and Mr. Producer over there said, is that I'm here. I'm here to help. That's my passion, is bridging the gap between renting and home ownership. And T, I'm sorry if I stepped on your toes,
Oh
but
no,
that's what I'm here for.
hey, baby girl. Hey, look. Either way, we educating the masses. So
Yeah,
that's
we
really what it's
exactly,
about.
and that's why I absolutely say it's a privilege to be on the show, on your podcast today. I
Man,
think it's awesome.
it's a privilege to have you. You just don't
Well,
know that
thank you.
the wealth that you share is not just for this show, but it's for everybody that's watching and for
Yeah.
somebody else that's not able to attend. They go back and tell somebody,
Yeah.
let them know.
Spread the
So
word.
that's what we
Yeah.
that's why it's
So
called
we
PNM.
here for it. Yeah.
Yeah.
Educate and motivate. We ain't just
Mhm.
giving it to you to just listen for it. We giving it
Yeah,
to you
do
to go
something
out
with it.
there and do it. You
Yeah.
know what
So
I'm
Mhm.
saying? So
here go your mama T Will to plug you and tell them what you offering them.
hey, they already know, man. If y'all on this show, y'all already know how y'all can reach me 903-705-3547. You can text me right now. I pick up that phone and be like, it's on. What we doing? You know your situation,
Yeah.
because when I do my consultation, I sit down with them and I tell people like, look, I'm not in your business, but I'm in your business because I like to do and Rhonda can testify to she know how I move on this one. I like to set my clients up to where before we go to the lender, we already done went through that. So by the time she gets them, they already fixed up. You know
You
what I'm
heard
saying?
it.
And all
Yeah.
she got to do is tell them submit your docs, do all the little stuff,
And
the
let's
preliminary
roll.
stuff.
Yeah.
Let's
Yeah.
roll. We'll get the product started. So,
Yeah.
you
So
can
that be
read.
jacked up. T Will get me straight. And then okay, Rhonda found a few more things wrong. So when I get to the underwriter, he better not say he or she better not say nothing.
Uh-uh.
Well,
No.
Like,
that's
listen,
that's that's a different story now.
Yeah, you ain't kidding. Because I didn't heard it. Well, you told me I didn't have to. That's
Yeah.
why I say up front, when you get to underwriting, they can ask you for anything that they want to. So don't think just because I ask you for everything that an underwriter is not. I'm just going to tell you the underwriter going to find something to ask you for.
Man,
period. That's just
underwriter
how it
ask
is.
you, underwriter ask you who your mama is, man.
Yeah, yeah,
Yeah.
I'm
exactly.
telling you,
Yep.
man.
Know your
They
mama's
want to
mama.
talk to them.
Yeah.
Yeah, and I just want to say, a lot of people didn't expect the market to be doing what it's doing now. So the
Right.
thing is, what's that old saying? If you stay ready, you don't have to get ready. There's some
Mhm.
things that are unfortunate that you don't know, and you can try to prepare, and stuff just happens. But I can tell you, if you if this is not the time to buy, that don't mean that you don't need to get ready
No,
for
Yeah.
no.
6 months
Stay
later.
ready. Yes,
So
stay
let me reach
ready.
out to either one of you and talk about like, hey, I'm looking to buy, in a year. I mean, y'all can
Mhm.
talk to them about at least what's going on right now, and
Yeah.
you're not, you don't see into the future, but you can at least let them know what they should be working on, or
Right.
Right,
maintaining.
exactly. Exactly. Now, I know that everybody called me and asked me to tell them what they're working on, but that's what I do. I mean, if you're looking, if you're seriously looking to purchase, I'm always willing to say, okay, let me see where you are. Let's have a conversation, see where you are, and if you're not ready now, let me look and see how I can get you prepared to
Yeah,
to
it's
get ready. If
important.
it's credit, I'll look at the credit report and see if there's maybe something that I can guide you to without just looking at. But if it's in depth and it's something that requires just a little bit more, then of course there are resources for that. And I know you guys have a credit repair person here on the podcast that'll
Yeah.
be more than willing to help.
Oh yeah,
Yeah. Yeah.
Okay.
And I
man, this
just
was
wanna I
awesome.
wanna let everybody know too about the Greenwood podcast that we have as well, because we have another one, Rhonda. I don't know if you seen it before, but we got one that we starting to do flex what like every other week on there, and we're just
Yes,
talking about
it's going to be the
the next
second
one.
and fourth Sunday of
Okay.
every month. Greenwood the podcast.
Yeah, so
Mhm.
we're talking about all kind of issues on there, community, social, what have not. But it's kind of based on the premises of the Tulsa, Black Wall Street,
Okay.
and
Well. Okay.
the
Yeah. I have
surrounding
to make
issues of
sure.
that. Yeah,
Yeah.
so we touch a lot of issues, and just to bring awareness to people of
Okay.
all
Awesome.
backgrounds, ethnicities, what you have it. So
Yeah.
we want everybody to be involved, and we want it to be a topic of conversation. So
No
that's why we
question.
got this cast together, and we
Yeah.
bring it.
Awesome. I have to check it out. I
Yep.
know
Yep.
I know it's a great
So
platform. Oh my
you're
gosh, that's
you're
great.
active on Facebook, Miss
Yeah.
Rhonda.
The Lone Lioness.
So we need to plug. So we want to send you some people, and you send us some of yours, and
Yeah,
another
absolutely.
bit to
Just
grow this
yeah.
thing. Yeah.
Yes, please go and like my page at the Lone Lioness. You can just find you can put Lone Lioness, the Lone Lion. Make sure you put the
D.
Lone Lioness, and I can pop up, and you're gonna be able to see this gold hair, so you know it's.
All right.
Right
Now
on.
one requirement for you though,
What's
you got to
that?
come back.
I'll come
You
back.
got to
I'm
come back.
come back.
All
I'm
right.
come back.
Got to.
Yeah.
Got to.
Most definitely. I'll be honored to. I had a great time. It was a lot of fun. And y'all
Yeah.
didn't beat me up bad at all. So I appreciate it.
We
Because
can't
your
we can't beat people up with knowledge.
you hear me?
Yeah. Yeah. That's what we're all about. We're all about giving
Yeah.
back, giving that knowledge. But
Yeah.
knowledge is powerful. But no,
Now,
it's been a complete honor.
Yeah.
You
one
want to
last
come?
question. This is gonna be a real test. It's gonna let us know how real you are.
Okay.
Catfish or tilapia?
Catfish.
All right, you good with us, man. You
Hey,
coming back?
hey,
Yeah.
hold
And
up,
the
Flex.
hot sauce and white bread.
Hey,
You better
Flex. What
know.
Flex? What you didn't understand? She from Memphis 10.
I'm from Memphis 10, but
Right
we're in
on.
Central South Carolina. Yeah.
She
Yeah.
from Memphis 10.
Hot sauce, catfish, coleslaw.
Yo.
There comes love. Okay, okay. Hey,
Oh,
all right,
And
man. It's
a
been a
hand of
blessing.
spades. And a hand of spades.
that
Spade, gotta have spades.
Yeah, I
you
have
gonna
Gotta
spades.
have
you
some
gonna have to
spades.
do that.
Yeah. Okay.
Yeah.
So you're in the Metroplex. So
Yes,
yeah.
I'm in the
So next time,
DFW area.
yeah, me too. We'll get together. We'll make sure
We're
we
gonna
tap.
invite her out. Yeah, she
No,
come
please
out with us.
do.
I
Yeah,
mean,
Please do.
yeah. Cool,
she
cool.
I
part of
would
the
love
game.
that.
Yeah,
Yeah,
Yep.
I
cool,
love
cool.
Yep.
that. I'm serious. Please do.
All
We
right.
will.
So one more time for the road. Here is Mrs. Hutchinson, Miss Hutchison's information.
Hutchison.
And pay
Yeah.
attention, there is no N after that
Yes.
I. So
Yes.
make sure you
Yes.
spell the name right, or
Hutchison.
you ain't gonna get that. You're not gonna get that email. Please hit her up
No,
with all
no.
your real estate questions, and you always can hit up a boy T Will, man. We got you
Yes.
covered here.
Yes.
Indeed.
Yes.
Yeah, cool.
Well, everybody, we coming to an end, and we appreciate everybody for joining in, and thanks for all your questions. Like
Yes.
always, y'all join us we here every Wednesday at 7 p.m. Central Standard Time. So y'all make sure to tune in to us, and bring your questions. We're gonna close it out today, and I'll let you close it out, Flex.
Peace out.
All right.
really do it for you. Baby, don't forget the floor is yours. Yeah, baby, I mean the floor is yours. If it come down to the floor is yours. Let me show you how prove the floor is yours. 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 The floor, yeah, the floor is yours.
Now it's my turn to tell you.
To next Wednesday. Well, I think Rhonda, she peeled out, but she didn't
She
know
was
we
like,
was
y'all
supposed
had
to.
me
Yeah.
long and right off. Hey, appreciate everybody for watching, man. We'll see you here Sunday. Please spread the word. Oh, yeah, we forgot to tell you, follow us on Facebook, Instagram, and especially YouTube. We're growing. We need y'all there, please. Thank you.
Let's go. Y'all have a good one.